I gave you few questions to try at home. Okay. So till illustration number 6, everything was done. Then question number 1, test your knowledge. I gave you this question to try at home. Okay. Please check your answers. Examine under which head the following incomes are taxable. First, rental income in case of property held as stock in trade. So even if the property is held as a stock in trade, the rental income will be taxable under the head house property. Okay, no? Second one, salary received by the partner from the partnership firm, PGBP. To the extent it is allowed to the firm, to that extent it is partners PGBP income. Specific charge is there, if you remember. Okay. Next one, rental income from machinery. It will be either PGBP or it will be IFOS. If not taxable under the PGBP, then it will be IFOS. Okay. Then winnings from lottery by a person having the same as business activity. So even if you are having this activity as your business activity, but under the Income Tax Act, it is not treated as business. So accordingly, even if you perform this activity on a regular basis or sometime, whenever you are getting some winnings income, that is always taxable under the head IFOS. Okay, no? Next one. Salaries received by the Member of Parliament. Salaries of MP, MLA, MLC taxable under the head IFOS. Next one. Receipt without consideration, meaning gift. It will always be taxable under the head IFOS. In case of retirement, interest on employees' contribution if PF is unrecognized. See, if there is unrecognized provident fund and the lump sum amount is coming to you, we bifurcate that lump sum amount into 4 parts, if you remember. Employees' contribution coming back is not your income, ignore that. Interest on employees' contribution taxable under the head IFOS, and employer's contribution and interest thereon will be taxable under the head salary as profit in lieu of salary. That we have already done with salary head. Okay, now? Next one. Rental income in case of a person engaged in the business of letting out of commercial properties. This will be PGBP. But if the business is to let out residential property, then explanation 3 to section 28 is inserted with effect from this year. Then that rental income cannot be treated as PGBP. Then it has to be income from house property. Yes or no? But this we will consider as PGBP. Did you get all the incomes correctly? Okay. Classification was okay, no? Okay, perfect. Now, coming to point number 2. Question number 2. Examine whether the following are chargeable to tax and amount liable to tax. And the amount liable to tax. Whether it is chargeable, if yes, then tell me how much amount will be taxable. First one, sum of 1,20,000 was received as gift from non-relative by Raj on the occasion of marriage of his son Praveen. So on the marriage of the son, if the son is getting something, then it is not taxable for the son. But if you are getting anything, it will be taxable for you because it was not your marriage. Okay. And if non-relatives are giving it, then it will be fully taxable. How much? 1,20,000 fully taxable. Yes or no? Next one, interest on enhanced compensation. The moment you will see the entire amount, that entire amount will be taxable on receipt basis. No matter to which year it will be taxable. But you are going to get a 50% standard deduction out of this. So out of 96,000, you take a 50% standard deduction, your IFOS income will be 48,000. Hello, sir. You got these 2 points? Easy, no? Answer was easy. Did you solve these questions? Sure, no? Next one. Now, on 10th of October 2024, Mr. Govind, a bank employee, received Rs 5 lakh towards interest on enhanced compensation from state government in respect of compulsory acquisition of his land, effected during the financial year 2016-17. So in 16-17, what happened? The compulsory acquisition took place. But the compensation for that you are receiving in 2024-25. On 10th October, you are getting that compensation. Hello, sir. And the compensation was rupees 5 lakhs. So tell me, that entire 5 lakhs will be taxable under the head IFOS. You are getting interest. You are getting interest of rupees 5 lakhs, that interest will be taxable. The compensation is taxable under the head capital gain, but the interest on that compensation will be taxable under the head IFRS. 5 lakh entirely taxable here. Okay, no? Now, out of that 5 lakh, you will take 50% standard deduction. 2 lakh 50 will be your IFRS income. Yes or no? Now, out of this interest, 150 relates to the financial year 17-18, 165 to the financial year 18-19, and 185 to the financial year 19-20. Forget about that. The entire interest received in this year will be taxable in this year. It is always taxable on receipt basis. He incurred 50,000 by way of legal expenses to receive interest on such enhanced compensation. This is his legal expense. So do you remember that when we calculate the capital gain, and at that time when we receive the enhanced compensation, out of that enhanced compensation we already get the deduction for this legal expenses. So this you would have already claimed as a deduction under the head capital gain from the enhanced compensation amount. And you cannot claim it as a deduction from here, from the interest amount. Yes or no? From interest we are giving you 50% standard deduction. No, that is sufficient. That will take care of everything. But this litigation expense or the legal expense which you have incurred to get the enhanced compensation, this will not be allowed as a deduction from your interest. This will be allowed under the head capital gains out of the amount of enhanced compensation. Yes or no? So, how much of the interest on enhanced compensation would be chargeable to tax? 2 lakh 50. That's it. Done now? Next one. Fourth one. Following details have been furnished by Mrs. Hemali pertaining to the year ended 31st March 2025. This question I gave you to solve at home. Okay, did you try? Let's see. Cash gift of 51,000 received from her friend. Friend is not a relative. So from a non-relative you are getting a sum of money more than 50,000. This entire amount will be taxable. And this was received on the occasion of Shashtipata Purti. Okay. So what is this? This is a function which we normally keep when the husband attains the age of 60 years. Yes or no? So that time a marriage like celebration takes place. So marriage like celebration takes place. It is not the marriage. Okay. And on that occasion, if you are getting anything that you are not receiving at the time of marriage, so the gift will be taxable because the amount is more than 50 and the amount is received from a non-relative. The entire gift will be taxable. Yes or no? Now, on the above occasion, a diamond necklace worth rupees 2 lakh was presented by her sister living in Dubai. So I don't know wherever the sister resides, but is she my sister? Yes. Is she my relative? Yes. So from relative, whatever gift I get, whatever amount, will it be taxable? The answer is no. It will not be taxable, whatever may be the amount. Yes or no? So that will not be taxable. When she celebrated her daughter's wedding on 21st February 2025, her friend assigned in Mrs. Hemali's favor a fixed deposit. Again, friend is not a relative. So from a non-relative, you are getting what? Fixed deposit. See, friends, fixed deposit is as good as cash only. As good as sum of money only. So if you are getting sum of money and the amount of that sum of money is more than 50,000 and that amount you are not receiving on the occasion of your marriage, you are receiving on the occasion of your daughter's marriage, and you are receiving not from a relative, you are receiving it from a non-relative. So this 52,000 will also be taxable. Yes or no? Value of the fixed deposit and the accrued interest, including that interest, is 52. So in all, total, you are getting how much? 52,000 rupees sum of money. That entire 52 will be taxable as your gift. So how much is the total taxable income from other sources? 51,000 plus 52,000, it will be 1,03,000. Done, sir? Everyone? Now coming to question number 5. This is the last question. Okay. Examine the following transactions in the context of Income Tax Act 1961. Mr. B transferred 500 shares of R Private Limited to Messrs. B Company Private Limited on 10th of October 2024 for rupees 3 lakh when the fair market value was 5 lakh. The index cost of acquisition of the shares for Mr. B was computed at 4,45,000. The transfer was not subjected to STT. Determine the income chargeable to tax in the hands of Mr. B and Messrs. B Company Private Limited because of the above said transaction. This is a good question. Mark it important. This part is important. This I am going to discuss. Give me 2 minutes. First, let us complete the second part. Mr. Chazian is employed in a company with a taxable salary income of rupees 5 lakhs. He received a sum of rupees 1 lakh from Atma Charitable Trust registered under section 12AB by account pay check in December 24 for meeting his medical expenses. If you get something from HUTLO, do you remember? H for hospitals, medical institutions, U for universities, educational institutions, T for trusts or charitable institution. So from any trust or charitable institution also, whatever you receive or whatever you give them, that is not treated as gift under the gift provision. Yes or no? So you are receiving something from a charitable trust as a help. How can we consider that as your gift? Even if the amount is more than 50,000, that amount will not be taxable under the gift provisions. Yes or no? Because it is covered by the exceptions. Will you remember this? Now the first part, see, very easy, very easy. What you are supposed to do? This is Mr. B. Okay. And B Company Private Limited. Messrs. B Company Private Limited. So now what Mr. B is doing? Mr. B is selling the shares. Okay. Shares of R Private Limited. Shares of R Private Limited transferred for rupees 3 lakhs. So the consideration is 3 lakh rupees. Is Mr. B transferring his capital asset or he is transferring his stock in trade? Mr. B is in the business of share trading. Mr. B is in the business of share trading. Is it given anywhere? Meaning that shares transferred by him is not his stock in trade. Shares transferred by him is his capital asset. So he is transferring his capital asset. To whom it is transferred? B Company Private Limited. B Company Private Limited is in the business of trading in shares. Is it given anywhere? Meaning the shares are not received by B Company Private Limited as stock in trade. Even the B Company Private Limited is getting the shares as what? Capital asset only. So the transferor is transferring as capital asset and the recipient is getting it as a capital asset. Okay, now. So for the transferor, Mr. B, don't you think capital gain would arise? Because Mr. B is transferring his capital asset for how much? 3 lakhs. So the consideration for transfer is 3 lakhs. But the fair market value as on the date of transfer was 5 lakhs. Meaning that the shares are transferred for a value which is less than its fair market value. And the shares are not listed shares. Shares are other than quoted shares. And for the shares which are not quoted, unquoted shares, if the fair market value is more than the sale consideration, then 50 CA will apply and the sale consideration will be ignored and the fair market value will be deemed to be the full value of consideration. Do you remember 50 CA? So 50 CA will be applicable here. Okay. Now taking 50 CA, taking that fair market value as full value of consideration, the capital gain for Mr. B will be calculated. Yes or no? Now tell me one thing. Capital gain calculation, full value of consideration will be how much? Fair market value as on date of sale, which is rupees 5 lakhs, and this you have taken under section 50 CA. Will you remember this? Less transfer expense, that is nil. So the net consideration will be 5 lakh. Now you will have to first see the period of holding of the shares in the hands of Mr. B. Based on that period, it will be decided whether the shares are short term or long term. And if the shares are short term, cost will be reduced. If the shares are long term, index cost will be reduced, provided the shares are transferred on or after, prior to 23rd July. But see, in this question, no, there is a drafting mistake, I will tell you. What mistake is there? Mr. B has transferred 500 shares on what date? Can you see the date? This is the date of transfer. And if this date is on or after 23rd July, whatever may be the period of holding, even if the asset is long term, yes or no, indexation will not be given. But see, in the question what they have written, index cost of acquisition to B was 4,45,000. So either you should have given the date of transfer prior to 23rd July, or you should have, if you want to keep that same date, ignore the word indexed. The shares cost of acquisition cannot be indexed, yes or no? And if you are saying that this is index cost, then tell us when the shares were acquired. We'll do the reverse calculation and we'll calculate the cost of acquisition. Even that can be given in the question. If the shares were acquired in 2008-9 and the transfer is happening in 2024-25 and this index cost is given, meaning the cost was not this much, cost was something else. So that we will calculate by doing reverse calculation. Into 363 divided by CII of 2009-10 we would have done, no, we would have done it reverse and we would have got the value, cost. But to that extent they will not go, don't worry. Okay, but if that was the case, even that could have been done in the question. But see, here the word used, index cost of acquisition, is wrong. It is cost of acquisition only. Okay, so take this 4,45,000 as cost of acquisition. That is 4,45,000. So 5 lakh minus 4,45,000. 55,000 will be the capital gain. Now what is the nature of this gain? Long term or short term? When did B acquire the shares? Nothing mentioned, they are saying index cost, no. So it is long term only. Okay, no. So this will be the long term capital gain on transfer of shares, which will be taxable under 112A. No. It would have been 112A if STT was paid and it was transferred through recognized stock exchange. Yes or no? But this will not be taxable under 112A. This will be taxable under 112 unlisted shares. Done, sir? So this long term gain 112 amount is 55,000. This will be taxable in the hands of B. Now if I talk about B Company Private Limited. B Company Private Limited receiving the asset from Mr. B. Relative, non-relative? No. No relative is there in the case of a company. Yes or no? So for company, definitely section 56, subsection 2, clause 10, gift provisions gets attracted. And under the head income from other sources, what the company will have to do? 5 lakh minus 3 lakhs. The amount is 2 lakhs. That 2 lakhs will be taxable in the hands of the company. Okay. Now think one step ahead. What if the company, if the above shares, transferred by B Company Private Limited, then that time capital gain would be computed in the hands of B Company. Now what if B Company would have taken the asset as stock in trade? Then this IFOS 2 lakh was not taxable for B Company because it is taken as stock in trade. Then in that case, whenever B Company will sell in future, it will be sold as what? Stock in trade. That time the 3 lakh rupees cost will be taken as cost of stock in trade. So the amount of gain which is taxable here right now, 2 lakh, would have been taxed as what? PGBP. But since it is taken as since this is taken as capital asset, hence the provisions of gift are already getting applied. Yes or no? And 2 lakh rupees is getting taxed in the hands of company right now only. Now this 2 lakh should not be taxed again. So for that, whenever the company will sell the asset as what? Capital asset, that time we'll have to take 49.4 as cost of acquisition. Now in the question, are they telling you that the company is selling the shares in the future? No. If the company would have sold, capital gain would have been calculated in the hands of company, and that time to calculate the capital gain, cost of acquisition would have been 49.4. That is nothing but the fair market value considered under section 56 subsection 2 clause 10 to determine the value of gift. Yes or no? And that was how much? That was rupees 5 lakhs. That would have been the cost of acquisition of these shares in the hands of company. Will you be able to solve a question like this in the exam? If this type of question will come, no, it will be for minimum 4 to 6 marks. Minimum 4 to 6 marks. Or a case study can also be created. Sure, sir. Did you copy this? Did you copy this? Sure. Should I move ahead? Okay. So this was your last question. Question number 5. And with this we have completed all the questions of income from other sources, and the chapter is over now. Okay. See, you have done all the difficult questions which can be possible in IFS. All the most possible difficult questions you have solved here only. So now there will be nothing outside this. What they can do exactly, they can mix and match few questions and they can create a new question. Okay, they can mix and match few questions and they can create a new question. That's it. That is what they can exactly do. Other than that, you are through with this entire chapter. Okay, did you like this chapter? It was easy. Okay, but compared to the thing which we were thinking that this would be easier, in comparison to that it is difficult. Okay, and usually people consider this chapter as an option only in the exam, and if you will keep this chapter in the option, there are bright chances that in the examination, in almost every question you will be losing something, because this chapter can come as a filler in main questions. So that part in the question will be wrong, which will relate to this chapter if you are keeping this chapter in the option. So very important chapter. Okay, do it thoroughly, do it properly. Okay, now we'll start with the new chapter now. Okay.